This podcast is brought to you by True Resources, connecting talented people with the best mining employers in the Australian market. For more information, head to trueresources.com.au.
So, hello, I'm Ben Kostrich, and this is the MarketBull podcast. Joining me on the show today is Steve Turner, the Managing Director and CEO of Nutritional Growth Solutions, which is listed on the ASX under code NGS. And we were talking just briefly before. It's been a good year since I last spoke with him, and there's been a lot of activity and a lot of updates and a lot of developments within the company. So, welcome back to the show, Steve.
Welcome. Thank you. Glad to be here.
If we revisit a little bit for listeners that are unfamiliar with what Nutritional Growth Solutions, if you bump into someone in the elevator and you're trying to explain it in that sort of elevator pitch, if the cliche can be used, how do you describe what NGS stands for and does?
Well, my elevator pitch or 30-second pitch is Nutritional Growth Solutions is a children's focused nutritional company that emanated from the medical community, creating nutritional growth shake mixes specifically to help kids grow and thrive. And that's really where we are and what we are as a brand. We are a science and evidence-based company that grew out of the need to create a product for medical treatment of children that were failure to thrive, short stature, having challenges with growth and development that didn't qualify for hormone therapy. And the physicians that created the product at Schneider basically looked around at the time, and their solutions were Carnation Instant Breakfast or Pediasure and some of these other products that were just high in sugar, high in fat, and full of a lot of garbage. The ones that had at least some reasonable nutrition in them, even with all the added sugars and such, were basically meals in a bottle, which is not exactly what the clinicians needed. So they basically set out on a journey, did a lot of research, a lot of animal work, tons of clinical work, culminating in the product that became what we sell as Grow Daily. And at the end of the day, that's the brand that basically formed the catalyst of creating the business. And so the company was founded or created by licensing initially that formulation to GSK back in the day. And they used that funding event specifically for access to that formulation for India to create Nutritional Growth Solutions. And so the medical founders and the host of individuals that were involved in creating the product created NGS. Fast forward to where we're at today, and we haven't really lost sight on those core values. Those are the values that drive my team. And my team is 100% focused in and around trying to find creative ways to get quality nutrition in the hands of kids, because life is busy, and we are all about basically filling the gaps and providing the necessary macros and micros that kids need in order to be the best versions of themselves. And so that's the company. And that's the long extended version of the pitch, but that's really sort of how we identify both as ourselves and what the brand is. You look at where we're at today, I go back to the beginning. I don't know how much we want to talk about sort of the pre-Quill before I became CEO, but the company has been trying to find its way both in market and variety of different geographies and sort of expand and get access of their brand in the hands of consumers around the world. And I was originally brought in to run just the US division, and they didn't have anybody at the time that really had the brand experience, the company and sort of consumer building experience. And that's really what my background is. And so I was brought in to sort of basically help take the US to the next level. Because at the time it was still fairly small, reasonably successful, but definitely needed some help. And so, I spent the first year with the company just sort of cleaning up the team, really challenging the positioning and identity of the brand in order to make sure that we could tap into the consumer and tie into emotion to be able to then drive interest and demand, and sort of also get it ready for retail. Because in North America, the majority of volume, the majority of sales are still done even in this day in a brick and mortar store. 30% of everything sold in the country goes through a Walmart, which is a scary number. You have roughly 7 large national retailers that account for the vast majority of all volume of CPG, health and wellness, health and beauty and cosmetic, and durable goods consumed in North America. And only about 25-30% of that is done online through markets like Amazon, through markets like Shopify, or direct to consumer efforts. And when you really look at the overall sales dynamic, as large as Amazon is, because it's a big company, they are a exponentially smaller component to the total volume of sales that most brick and mortar stores generate, especially a Walmart. And so it's still important to be present, to be visual in front of the US consumer. We're still very tactile, especially for a nutritional product that you're putting into your children. You want to make sure it's the real deal, that it's real. And if it's not physically present in a store, it's hard to be relevant. It's also hard to be able to confidently convince the caregiver that that's an ethical product that they're willing to try to put into their kids, because, you know, we elevate our children and our pets beyond our own needs in many cases. And so that's important. So it was important for us to sort of start the journey to get into retail, and it's a long play. And that's the challenge. And so the goal is positioning. The goal is to find ways where we could be channel specific depending on which retail channels we wanted to focus on, understanding our competitive frame, making sure that we knew where the consumer was, who she is as an individual, and what we needed to do in order to basically tap into that consumer so that we can get engagement. And it's a journey. And so typically the plan that I would have approached with would be start with a small regional or semi-regional chain, work with some natural products distributors, start getting some placement on shelf. Even though that's super expensive, that's typically where you would start as an emerging brand. And then as you demonstrate to the rest of the market that you are real and relevant, then you start generating success stories through sales, and then you grow into bigger and bigger until you get to the national chains. Well, what had happened with us was serendipitous. It was luck, timing, and just network effect. I'd come on board, been in the industry for several decades. Abbott had made some poor decisions on quality control measures that resulted in their facility getting shut down in North America, and the entire infant formula and toddler beverage market just disappeared overnight. Yeah. And so you had retailers looking around their stores with shelf space that's just empty with product. And Walmart was the most directly impacted. They had roughly a 40% gap in product on shelf in their stores because of this shortage. And so I had a savvy merchant reach out to me that was willing to give a shot to sort of test, could I take a premium children's centric nutritional product and put it into the same marketplace that's very value and price driven, and will it work? Because at least I've got empty shelves. I could, start doing some tests with brands. And so that's really how we got our opportunity. So of course we're a small company. Walmart's not going to give us a huge business opportunity because it would put us out of business just because of the financial resources required to build enough to get everywhere. So we've basically been doing this test for the last couple of years. And sorry, you froze there. I wasn't sure if you caught me, but we've been doing this test for the last couple of years with them to basically demonstrate, can we show that we both have organic and intentional selection by a Walmart consumer to buy our brand? Because we sit on shelf for more than most of our competitive frame, because we're a premium product. We don't have a lot of the cheap garbage that most of our competitors have in there. We have anywhere from 2 to 3 times the protein content, and of course, the high quality types of protein. So again, it's a little bit more expensive product per serving than the rest of the items on the shelf. But what we've demonstrated year over year, and getting the planograms renewed year over year, is important. Consumers do actually gravitate to our product, and I think nutrition, especially in a children's nutritional product, is key. And we win on that every single time. When a consumer picks up our product or sees our product on the shelf and they look at the facts panel and compare it to what they're maybe buying previously, they're going to see a lot of really good reasons why they should give it a shot. And then of course, because it tastes good, because it's really kid friendly, it's just a matter of continuing that groundswell and basically building enough of an audience around that. And over time, we will see significant gains in distribution. So, we've had our planogram now renewed twice. We have a merchant that's on the desk that is really engaged with us and is working with us on a variety of different promotional vehicles. And I fully expect to see continued growth within Walmart. we were invited to Open Call, which is a fairly limited invitation-only event that they do specifically to cultivate and foster U.S. brands that are manufactured, sourced, and made in the U.S. And so having a brand that we're actually able to do that, all of our product for the North American market's made in Utah, and we operate out of San Diego, California. So we're an American brand in the eyes of Walmart. And so they provided us an opportunity to basically have education, exposure, as well as pitch ideas on products to the merchant team. That resulted in us creating and launching our first digestive product that we introduced last year at Walmart. We were just invited back again. So I was just in Bentonville last month at the event. And again, it's a 2-day event, a lot of opportunity. And we sat down, we had 2 good merchant meetings with 2 distinct merchants, and on yet another item that we don't have in distribution at Walmart. So again, I fully expect that Walmart wouldn't be providing these types of resources if they truly weren't interested in our brand. And so the goal is continue to be there, be present, show that we have the ability to get items off shelf, support the velocity, continue to market and be savvy, learn what works, learn what doesn't work, and do it quickly. Over time, we will see growth. It's just going to take time to get there. So the e-commerce business for us is important because it's our bread and butter. But the long-term play will always be future gains in distribution, whether that's new items with Walmart, or more doors with Walmart, or getting into CVS, getting into Walgreens, getting into Target and be the other mass play in the US, getting into the club channel, whether it's Sam's Club or Costco, getting into the grocery space, which of course is the greenfield that we're working on now. So there's so much opportunity, and that's what we're working towards. We will eventually get to the point where our online business is 30%, maybe 40% of the pie, and our brick and mortar in-store business is the rest. And the difference will be I'll have a portfolio of several dozen items that I sell online, and I will have a portfolio of just 3, 4, maybe 5 items that I sell in a store. And those 3 or 4 or 5 items will generate more dollar revenue and volume than the entire portfolio will do online at Amazon or on Shopify. And so that's where we're headed. So now it's just a matter of continuing that journey. So the things that I've been doing most recently is, again, continuing to control costs, find ways to be more efficient with the money that we do have to work with, drive growth, and then of course look at ways where we can bolt on incremental revenues. So we just signed up a distribution agreement, and we're going to enter into the Asian market with our US product. So it's a low risk play because it's coming off of my existing manufacturing lines. I do not have to nationalize it for the region. And it's done in the bonded exchange through an e-commerce cross-border model. And that's all serviced and supported right here out of LA, California. So again, it's a simple, easy way for me to bolt on incremental revenues. We just signed a license with Healthy Chef, which I'm really excited about, and we're going to launch in the first quarter of 2025. And we've selected the top items from a dollar and engagement and revenue standpoint, and pretty excited about what we can do with that, because once again, it's an incremental play that's a product specifically for the mom that we've been marketing to with our Healthy Heights brand. We have synergies in the naming. So I have Healthy Chef and Healthy Heights. And so they're both nutritional powders for health and wellness. And so again, it's an easy adjacency for us to sort of add on incremental revenues. And so we're going to continue to look at opportunities like that where we can add items, generate scale in a low risk way, so that over time, in the very near future, we're going to generate more money than we burn. And that's the mission. So, the burn rate and getting to cash flow positive, I'd originally hoped to do earlier in the year, but obviously that didn't happen. We, very much cash constrained and been basically in survival mode until the most recent raise that we did this last July. And that's finally given me enough working capital where we can sort of turn that trajectory around, add slightly more incremental investment in marketing in order to then drive that base business and see the sales recover, which we are seeing. So the good news is we see a lot of excitement in the very near future. We expect to get to a point where we're break even on a run rate basis, and then get to a point where we've now got cash that we're generating that we can continue to reinvest into the machine and drive additional growth. And so I'm pretty excited about what next year brings for us, because that's the sort of inflection point as we turn the corner get into calendar 25, and continuing our mission of getting more and more distribution, getting more and more sales, and most importantly, generating more revenues.
And one of the points that we were talking about before we started recording was the realization in 2023, when you became the MD and the CEO, was the refocusing or repositioning of the strategy and taking a different approach to get those sales and move away from, especially as you said, the US sort of side of it, where saying that you're a medical product doesn't really resonate with customers, to repositioning the brand that it is more about, we're here to support your child's development, your growth, and now tacking on the other products and I guess food sources that are coming along the lines. How has that sort of whole strategy been adopted and sort of configured over this past 18 months? And in doing that, as you said, the strategy has been about growing and getting in more shop fronts and now expansion. But how have you been successful in adopting and shifting that? Because the whole real direction is changed.
Yeah, exactly right. And it's a good case study in sort of being too close to the idea of what the product was originally when it was created, and also not having brand building or CPG expertise to sort of lead the charge. And so the issue is, and it varies by country, but in the US, we don't have a large population of malnourished or failure to thrive children per se. We have a lot of kids that have horrible eating habits. We have a lot of busy kids. We have a lot of kids that are on a variety of medications that suppress their appetite. But we don't necessarily have your classic sort of failure to thrive. That's probably less than 3%, of the total population of kids, under the age of 10. And so the challenge that we had is that was the focus, because that's where the product came from and that's what it was designed for. The pivot, though, is that that doesn't sell because it limits you to basically being a medical food for special medical purposes. And then you're looking at solely operating like you're a prescription drug, and it's a costly endeavor to detail physicians and so on and so forth, and way beyond the capital that the company had to put to work. And so it was important to find a way where you could tap into emotion. And of course, the goal was, and we learned this by analyzing our customer service data, by analyzing the insights and feedback that we were getting from the consumers that we did have that loved the product, and recognizing pretty quickly as you analyze that information that the consumer wasn't somebody that was the shrimp in the class that wanted to become, the big guy in the class. That was part of it, but it was really more of a sort of providing a product that helped the child thrive and be the best version of themselves, which then led to better confidence, which then led to all these great things, right? And so that's really what the brand needed to tap into. So it was finding a way to position it in such a in front of a consumer to basically say, okay, I'm no longer going to try to tell you that your kid has something wrong and that this is a solution for something that you may or may not believe that they have a problem with.
About. Yeah.
Right. What we're going to do is going to say, you know what, we recognize that you're busy, and that's okay, because busy parents are still great parents. We recognize that you have concerns because you watch your kid just eat chicken nuggets or only eat Cheerios day in and day out. You got to wonder whether or not they're getting enough. You see their friends, maybe some of their friends are bigger than them, and you have concerns. So we are now a tool, and we were trying to position the brand to basically become a resource in this tool chest of life that caregivers need, and sort of become that anxiety eliminator, and be the gap filler that's fun, that the kids like to take, that they love to engage with, that helps provide the necessary building blocks they need in order to be happy, thriving kids. And what's happened over the last year and a half is, with the introduction of our preteen formulations, we've really started to tap in and unlock this large youth sports community that, again, these are children that aren't necessarily failure to thrive. They're just busy, active kids that need a lot of fuel.
And then needing the nutrition.
And there aren't many products available in the market for kids between ages 2 and age 16. Their only solution are buying adult products. And then, of course, trying to figure out, what do I take? Because I'm not an 18-year-old man, I'm a 10-year-old boy. And so, again, just being that solution, being a resource, tapping into the fact that we actually have a product that's fun to take, the kids like, that sort of just fills the gaps and eliminates the concerns. And that's really what the position change was for us. That was a pretty big shift because it took a lot of internal work for me to then convince the innovators and basically the way the company was thinking at the time. And it's corporate inertia takes a lot of effort to sort of change direction. So we had a lot of internal change to do. Then we had a lot of packaging work that we had to sort of undo that had been done, and sort of find a way to basically reestablish some form of equity with the brand and build on that. And then, of course, also adding to the team people that had experience so that we could continue to grow and be as efficient as we could be being a small company. Changing the physical packaging format so that it was shelf friendly, so that we didn't have to worry so much about the stock clerk cutting through half of your product as they open up a case in the back office just to put things out on shelf. Simple things like that, but that nobody really was sort of thinking of because they weren't CPG folks.
Not that experience from it.
Yeah, exactly. And so, that was the first year and a half or more. And, I think I underestimated the amount of time it would take. But then again, this was coming out of the pandemic and things just seemed to take longer. What normally would have been a 6-month project was 12 months. And that was, that's just the reality now. And so, now we're at a point where when I stepped into the helm a little over a year ago, it was, okay, now it's cleaning up the organizational, find out how we can cut out operational waste, make sure that we focus on markets that are working, turn off the ones that aren't, fail fast is sort of the theme, and really starting cleaning house. And so we've come a long ways because we've gone from a company that, from an annual operating run rate was burning $6 million of cash a year down to roughly $3 million. And then we have a business that in the US by itself is generating circa 3 million or more US just within the brand that we have. And so if it wasn't for all the public company expenses, the legals and so on and so forth, we'd have a profitable company and the ability to sort of invest and grow. But that's not our reality. So that's what we've been working on trying to correct and fix. And so now we're finally, with the investment that we put to work starting in August of this year, seeing sales return, being able to invest in inventory so that we have more suitable weeks of cover so that we can survive little disruptions in the supply chain, start tacking on other markets that are all incremental, low risk plays for us to basically build scale. So now it's all about scale, and that's the charge. So we're going to turn the corner, get to break even, cash flow positive in the near future, and then start growing by basically generating more sales. And we'll do that by growth within our existing portfolio, but also by adding things like Healthy Chef that we just added, by adding additional markets like Vietnam and China that we just signed up, and continuing to support the base business so that collectively we then have a business that's much larger, much healthier, and then of course gives us opportunities. And then of course the share price will eventually start to take notice and hopefully go the other direction so that I can start returning value to our shareholder base and get back into growing the company versus just trying to shuffle the decks on the Titanic or whatever it may be, euphemism you want to use, and go from there.
There's a few points I want to pull on there, but first and foremost, the curiosity I have is, again, the pandemic, shopping behaviors and patterns. Everyone had their assumptions that when we came out of this, that online would be really first and foremost the main sort of culprit of shopping, and that consumers' patterns will have been irreparably changed and set in their ways. And my curiosity is seeing, I was thinking assumption that people have actually enjoyed going back to the shops and going to their actual shops and purchasing from shelves, and then potentially then doing it online afterwards. But from your point of view of seeing how this has happened and coming out of this pandemic, where do you think or see consumer patterns and purchasing patterns have adopted or changed, or what is the current state of the consumer's mind with shopping like this?
What I've seen is the shopping patterns and behaviors with consumers really haven't dramatically changed. It's still very much a tactile experience. What Amazon's growth and what online sales, web sales growth has been, probably accelerated several years from where it was growing. Probably pre-pandemic, you could say it was maybe growing at single-digit percentages year over year, but it was still only, a small 10-15% of the pie kind of idea. And now it's at least a quarter or more of the total revenue generated in CPG. But people aren't necessarily searching and prospecting online per se, especially when it comes to health and wellness products. Now, I might go and try to find a cheap $20 speaker and be willing to buy that on Amazon because, I can find something cheap and easy. I don't have to go to the store to look for it. But when I buy dietary supplements or when I buy consumables or even clothing that fits me or looks good, I usually have already engaged with that item in store. And so the stores become sort of that front end experience piece of it. And I've heard and seen a lot of retailers do presentations and talk specifically about how they're modifying their physical store footprint to be much more experiential. And so they're also just trying to figure out what they need to do. E-commerce is definitely a much larger piece than it was pre-pandemic. But, I think people, myself included, discounted how much they enjoyed actually just getting out of their freaking house, right? And not having to wear a mask and worry about, oh my gosh, this, there's a super spreader event.
Well, the human interaction element and just the whole exposure, bumping into your neighbor or whatever, and having a yarn at the shop.
Yeah, exactly. And so again, the assortments have shifted, but they really haven't shifted dramatically. Some stores have changed their footprint, but the vast majority of the daily consumables, the grocery stores, the corner store, pharmacies and such, are really no different than they were pre-pandemic. They're just a lot more crowded because people are out in them and looking at things and engaging and such. And then you have large big box stores like Walmart that have sort of shifted their footprint. They have a little bit of fulfillment in the stores themselves, but that's really more a competitive tactic to compete with Amazon, because they use the store in and of itself as its own little mini distribution center because they have stores all over the country. And so, the idea though of walking into a big box store and getting your hair cut, getting a pizza and a cold beer, buying your groceries, getting your drugs, getting clothing, getting a shot in the arm, for your flu shot or whatever it may be, those aren't nearly as developed as everybody had thought they would be by now. We still sort of go to our various centers depending on what it is we're looking for. So grocery stores where we get our food and vegetables. We go to the drugstore to get our dietary supplements and things like that. Exactly. Yeah. And so those behaviors are still very much the case. And when you look, reading through current news, I know the U.S. drug chains like Walgreens and CVS have been really struggling and having some challenges because they're learning they either expanded too quickly or added too many other non-pharmacy related items to be more than just a corner pharmacy. And now they're shrinking back, recognizing, I think in a lot of ways that we go to a Walgreens because we're getting our prescriptions or because we want to buy our health and beauty or our dietary supplements or maybe even get our flu shot in the arm. And that's about it. We're not going to a Walgreens to buy eggs, to buy vegetables, to buy groceries. And so
you don't expect to get your butchery mates from
they're and their profitability is all out of whack because of these, evolutionary changes that they thought they needed to make that I think they're realizing now that need to go back. And so you're starting to see a little bit of contraction with the drug chains, getting back to the basics of what they were, moving away from some of the services and other things that were sort of non-core to the pharmacy model. And same thing you would see with grocery and mass and so on and so forth. And so, again, the behaviors are really no different. I think we certainly are now consuming more online, but we're not like the Asian markets that are 50-60% of the goods purchased online. We're just not there yet, at least in North America. And of course, what I've seen and heard and experienced even in Australia is sort of where the US was 15 years ago, right? So Amazon is really in its infancy in Australia, not nearly as developed as it is here. And so that will come in time as well, but it's all part of the
baby stuff,
the journey. Yeah.
And the other point you mentioned was, again, the brand development, but the expanded ecosystem, and that path led to a Healthy Chef. And for those that are unfamiliar with that, it's an Australian brand, but talk to us about the strategy behind bringing that in and I guess bolstering it on to the range that the Nutritional Growth Solutions has, and what's your plan going forward to launch that into 2025 on shop fronts and where?
Sure. So again, our NGS's biggest challenge is scale. And if I had the luxury of limitless funds and time, then it would just be a matter of build the scale on your own. So we're sort of at this build or buy type of idea. And what we learned, or what I hope we learned as a business, the previous attempts where we were trying to invest heavy in specific product manufacturing and so on and so forth for different export markets that didn't work, just did nothing other than burn cash. So it's important for us to find low risk, low hanging fruit, easy wins to basically bolt on incremental scale. And so Healthy Chef came about because that's a brand that's been around for nearly 18 years or more. That's very much both a lifestyle and product line that is very closely tied to Teresa Cutter, the innovator and the call it the founder and the celebrity behind the brand. But what is great about that brand is, there was some interest in trying to get into the US market just because of the size and scale and what that represents. But Paul and Teresa, I think, recognized that they didn't have the skill set to be able to execute on that, right? So luck and timing, network effect again, I got a chance to meet with them. And this goes back to the beginning of the year. And, we created a really great relationship in the sense that I love what she's created and I love the brand. And it's very similar in form and function to what we do with our brand, Healthy Heights. And aside from the naming convention being serendipitous, again, it's a product now that I can then offer to the mom that we've been marketing to specifically with Healthy Heights. And I can also replicate the product very easily in my existing manufacturing. It's just a matter of making sure we don't lose its identity. So Teresa and Paul come with that brand. They are very much going to be our brand ambassadors and important part of the mix. But it gives me, again, a simple, low risk way for me to bolt on scale because they're items that my team is familiar with. The marketing message is similar. And it's just a matter of making sure that we don't go too big too quick with the manufacturing and tying up an inventory. And so we're going to launch in 2025 online. We don't, we will eventually work it through the retail channel, and that will come as it does. But we should be able to bolt on a really nice business just based on what has been created in Australia, specifically and around what the brand represents. And we're going to continue to look at other ways where we can do low risk incremental wins that provide scale. So most recently, we just announced that we're entering China and Vietnam again. And we've been able to
took the words out of my mouth. But
two distributors. Two distributors came to us. And of course, again, because the time was right, but it's another opportunity where I now have two partners that we've entered into distribution agreements with that want to take my existing US product, the Healthy Heights brand as it sits, and actually capitalize on the demand and interest that they see in their markets in China and in Vietnam and in Hong Kong. And again, so it's another low risk way for me because I don't have to do any unique packaging. I don't have to do any of the customs clearance, import, marketing, lifting, and all the activities in that geography. I can continue to basically just work with my partner and give them the product and the incentives and resources for them to basically
sell it,
succeed,
bring it to the market.
And then I win because I have revenues and I have product that's already being made. And then my volumes go up, my prices go down, my margins improve. And it gives me, again, a simple incremental win where I now have additional scale in revenues in a very simple, low risk way. Now, over time, it may make sense to then look at, okay, how do we then regionalize in every one of these different geographies? Do we make the investments in registration, which in a lot of these countries takes years? So there's no need to do that now. We can basically get the brand in front of the consumers, leverage partners that understand the market. Then I'm not trying to understand the Chinese consumer because I have a partner that already understands it, that's doing the work. We help translate and communicate our marketing assets back and forth, but they're doing everything, right? And so of course my gross margins on the product aren't as huge as they could be if I was selling it here, but the net contribution at the end of the day is as attractive as my existing retail business. And so it's a nice way to once again bolt on scale in a low risk way. And so we'll continue to look at opportunities like that, whether it's other brands, and ironically, the last company that I was with before I came on board with NGS was PharmaCare, and I was in the Americas portfolio of Pharmacare, which is another Australian CPG company. And there's at that time, we were looking and exploring at US items that we were then bringing into the Australian market, sort of in the reverse. And so now here NGS has an opportunity where we're looking at low-hanging fruit, where we can look at an Australian brand that doesn't exist in the US market and help translate that and be successful, because that's what we do and what we know and what my background is. And so it's about finding some of these opportunities that make sense, where we can, again, create scale. Because if we can do it in a way that the risk is low, then the reward is high for us, because we are so close to that point where we go from burning cash to making cash. And then once we flip beyond that exchange, we can then continue to reinvest those profits back into the business and grow at a much faster rate. And so that's kind of the point that we're getting to this year, with our current trajectory.
And I'm assuming, taking the words out of your mouth there, that is the priority going forward, is converting to cash flow positive to then continue the expansion. I know that's realistically been a goal that's talked about, but the realization of kicking in and some factors that happened last year and probably even into early this year sort of set that back. But going forward, what really can investors continue to expect or see coming from NGS leading into 2025 and onwards, as these new products are developed and the Walmart expansion continues, and new distribution partners and economies open up for you to target? What else, and what are some of the keys that you'd urge people to remember?
Yeah, the key is we have to remember it's the retail play is the future, and that's the only way we will get to a physical scale big enough to support a valuation that we all want. And that's a long play. Retailers think in periods of 12 months is the smallest piece. And they plan, a year or more in advance of when they set the new modulars. And then they do these large chunks of business. And of course, only like to work with brands that they know will either trigger footfall and have the demand, or are these huge established giant brands that everybody knows. And so the long play, and just having the discipline and understanding that the long build over the next months and years is going to be continue to grow the physical brick and mortar presence in North America, and watch for news flow that talks about, have we renewed modulars, which is good, because if we've renewed a modular, that's another year of business opportunity we have at that with our trading partner. Are they engaging with us? Are they investing resources in us? Do they actually care about us? Are we, how is our relationship going with the trade? And look for things like that. So that's going to be combinations of meeting events. Obviously, everybody wants and looks for new distribution agreements with new retailers, expanding into different channels. Again, just showing signs of life and presence as we continue down that journey. Those are the things to look for. What you don't want to hear is, well, it's over. They've kicked us out of the store. We're not getting the modular renewed. And so so luckily, fortuitously, that hasn't been our concern. But again, watching for signs that the retail game is still working and still going, and recognizing that even though you may, as an individual or an investor, want it right now, it's not the way it's going to work. It's going to happen at the speed of business. And then that means underlying fundamentals need to be healthy, so that we have the ability to let that cook, so that once it's ready to, come off the oven, that we can then capitalize on that growth. And so cleaning up the fundamentals of the business, cost disciplines, cultivating and growing in a healthy way our e-commerce channels, because those are near-term revenue streams, the bread and butter of the daily meal. And so over time, fast forward a year, 2 years, 3 years down the road, the e-commerce piece still is important because it's bread and butter, but it's a much smaller part of what we're focused on.
Strategy and pie.
Yeah. And then again, making sure that we understand, most importantly, who our consumer is and how we engage with her as an individual. And so making sure the company is agile, is able to fail fast and continue to pivot quickly, not getting stuck in bureaucracy and being a big company, right? Small companies have that advantage. And so those are the types of news announcements that we should watch for. So that would be, are we present and active in industry events? Are we relevant, present in front of the eyes of the retail partners, right? Are we getting modulars renewed? Are we getting interest with buyers that are willing to invest significant resources to set us up as a vendor? And I know a lot of people have been hyper-focused when I hear occasional comments and mutterings from investors about CVS. And what's interesting to note is CVS invested in us, and we are actually set up as a vendor of record. And that in and of itself is a big feat, because that costs them real dollars in order to go through the whole setup process. So while we haven't kicked off the modular, we haven't quite found our spot specifically within the CVS stores, they were committed and interested enough to set us up as a vendor. So that is still a big accomplishment. So over time, we will then have future announcements of, okay, here's the modules we're going into, these are the products that we're launching, and this is when it's going to happen. So just having the patience to let that go, and understanding that retailers won't make investments like that if they don't intend to eventually work with you as a vendor, because it's just wasted money. And so look for future announcements where other retailers are interested in setting us up as a vendor. Whether it's a big retailer or a small retailer, those are all the sort of news pieces that we want to hear, and also recognizing that they come infrequently. So it's not going to be something that you can say, well, he said he was going to be in CVS by Friday. Well, now it's Friday and we're CVS. So just trying to be a little bit more understanding that it's a long play, and that's the goal. So then again, fundamentals are important, cost control is important, making sure that we grow our base business, if we can get that base business, which we are doing, to a point where it then sustains everything else. Now we have the luxury of picking and choosing where do we want to be, or where do we want to sort of force the equation quicker. Getting into different reviews, different channels. So the Healthy Chef is important for me because I've been consistently talking to infant, child, toddler nutrition specialists and carving a little bit of room into the vitamin and mineral specialty space with the children's line, but that's all I can talk to. So that's one calendar point in a year. Now I have the Healthy Chef that is a different consumer, different channel, different category. And not only that, their portfolio is spread across 4 different categories. So now I have 5 touch points between Healthy Heights and what Healthy Chef represents to talk to and engage with merchants. And so it's just a numbers game. So theoretically, if I have 5 times more touch points, then we should expect at least some relative percentage of distribution gains on something in that portfolio. So it's about having a broad portfolio that, again, is focused in concept so that we don't get too distracted. I don't want to be a house of brands that has bug killers and food products and dietary supplements. We're going to be a health and wellness based company, and having brands and products that are all sort of in the same general pool. And that's what Healthy Chef represents for us, and then we'll look at other opportunities along the way, which again, give us more bats at the ball, more steps at the plate, whatever the sport analogy you want to use to, to get there. But yeah, that's ultimately the goal.
And of course, for investors and or even customers that are looking at these products, I know that Healthier and Healthy Chef, and Healthy Heights both have Instagram and again that e-commerce capabilities. But to get access to this news, a website, ASX announcements, where can investors both follow and potentially stay on top of the news flow that does come out? And as you pointed to, not every Friday will expect an email update, but as that thing does come, where can they go to sort of stay on top of all of this?
Well, our corporate website, NGS or ngsolutions.co, we have an investor center portal there that at least pulls down and consolidates all the public announcements that are posted and supported by ASX. And the ASX announcements are predominantly going to always be left to some type of material sensitive, price sensitive sort of business advancement announcement, or there'll be the customary quarterly financials that'll have also business updates in them. And then we're going to also, where we can, start putting out news through our LinkedIn pages, as well as on all of our web page fronts, whether it's with the brand specific or whether with ngsolutions.co, so people can at least see what's going on. And then over time, as we have scale and personnel and additional resources to deploy outside of just generating market growth, then we'll be able to start doing more of the customary IR, PR types of events where we can get, additional information out. But, obviously I'm an email away, I'm a phone call away at any point in time, and anybody can get a hold of us through our web portals and then send information or questions in, and I'm happy to engage. Usually So knock on wood, the vast majority of the emails I've gotten from investors I've responded to. It's just, don't expect it to be right away, but I definitely still want to make sure that we have those touch points because again, it's important to let people know what's going on. But all the big events that happen will certainly be shouted as loudly as we can from our little soapbox, and posted through the typical news outlets, whether that's through the ASX or through PR Newswire or BizWire or any of those other conventional means.
Fantastic, and potentially more podcasts. But
Yeah.
thank you so much, Steve, for joining me on the show. It's again, there's a fair bit happening, especially into 2025. So I'll be getting you back on again to hopefully talk about some of the exciting new updates and the expansion projects, and even just how sales are going into next year. But yeah, thank you so much for joining me and speaking on the show today.
You're welcome, Ben. Always a pleasure. And hopefully it won't be a year before we get another chance to talk again.
Thanks for listening to the MarketBull podcast. Please remember that the topics and stocks discussed in this podcast are not financial advice. If you enjoyed this episode, please make sure to like, share, and follow. You can follow the MarketBull on all our socials and keep up to date with global market insights.